GM, good morning. Welcome to the Milk Road Show, the daily crypto show where we keep the summer vibes alive in our crypto insights even as the days get shorter. I'm your host, Jay Hamilton, and we are joined today by Kyle Reidhead, co-owner and head of research at Milk Road. In today's episode, we're going to talk about how do you value L1 blockchains. And there's a few key things here that people are missing. There's a lot of conversation going on right now on crypto Twitter around, are L1 fee revenues the most important thing in order to value an L1 blockchain? When you're talking about Ethereum, when you're talking about Solana, if you're investing in these, you want to know, how do you value these blockchains now and long term? And you're going to understand throughout this episode that there's a little bit of a mistake that everybody's making that we're going to set the record straight on. And we're also going to talk about, when you value these things, what is the most important thing in the long term in order for these investments to be strong in your portfolio. Now, before we jump into today's episode, we just need to take a moment to hear from our fantastic sponsors over at Gemini and Kelp DAO.
Discover Gemini, the US-based exchange built for new and advanced traders. As a special welcome gift, they are offering new customers $15 in Bitcoin just for trading. At Gemini, security is a top priority. As a licensed full reserve exchange and custodian, your assets are well protected. Plus, they offer cutting-edge security features like passkeys to keep your account safe. This exchange is setting the standard for compliance and innovation so you can trade with confidence. Head over to gemini.com/Milk Road and start trading today to earn your $15 in BTC. Sign up now and get ready to join the trading fun.
Get ready, because your reward farming game is about to level up. Introducing Gain, powered by Kelp, your DGen concierge. Gain is an automated vault launched by Kelp that maximizes rewards for ETH users. It offers one-click access to airdrops and points from leading L2s like Linea, Scroll, Karak, and more. Here's how it works. Head over to milkroad.com/Kelp Gain and spot airdrop Gain. Get a complete overview of how your assets are deployed and the rewards and points you stand to gain. With just a few clicks, deposit ETH or SETH or liquid staking tokens into the smart vault. That's it. The best part, once you deposit, you're issued a liquid token, AGETH, enabling you to participate in DeFi on Pendle, Spectra, Lyra, Splice, and others. Gain is already live, and you can go check it out for yourself today. Just head over to milkroad.com/Kelp Gain and get started. Kyle, what's up, my man? Good to be back.
Jay, welcome back. How's the honeymoon? It feels weird for me to be on this side. I'm used to be interviewing, and all of a sudden now I'm being interviewed again. This is exciting.
Well, thanks for holding down the fort for me while I was off. The wedding and the honeymoon were amazing. No time like having time to relax when you have a 1-year-old. I didn't have my 1-year-old for a full week, and I got to sleep and hang out with my favorite human, my wife. So couldn't
Close
have been
the phone,
better.
not look at markets. I kind of wish that I was you during that time, but hey, we're back. We're here. We're ready to go.
Okay, let's get into the topic of today's conversation. Kai, you've been really active on Twitter this past week, trying to set the record straight on something that a lot of people seem to be making a mistake on. And I don't blame them for making this mistake, because when you think about a business, obviously you're going to think about revenue and profit and loss. Like, those are the main things. And so when you think about a blockchain, you think, okay, well, how does a blockchain make money? Well, they make money off fees. So fees must be very important. Why is it that you feel that people are overestimating the importance of fee revenue when they're valuing L1 blockchains like Ethereum and Solana?
Yeah. So first, most tokens in crypto, I think the revenue, the fees they're making, they really matter. Profit and loss, as you said, businesses, it matters. So for everything that's not an L1 asset, I think that really matters. If you're looking at Maker, you're looking at Aave, you're looking at whatever it is, of course, they need revenue. It needs to be sustainable. L1 native tokens for blockchains are a little bit of a different story. These are not necessarily businesses. Yes, they sell block space, but the assets for the blockchain, so ETH to Ethereum and Sol to Solana, are a little bit different, in my opinion. Ethereum, Solana, these are ecosystems, right? Think of it similar to like a country. And in these ecosystems, while revenue matters a little bit and fees matter a little bit, I actually think it's the moneyness of these assets that matter much more. Now, everyone hates that term on crypto Twitter. I feel like if I say the word money, you get a million reply guys that are like, that's so stupid. This stuff's not money. What are you talking about? I'm never going to use ETH to buy coffee, blah, blah, blah. It's not what I'm talking about. So we'll maybe clarify that in a little bit. I just think as an L1, the way that it works is we need to, and they're going to get commoditized. They're going to consistently try to be cheaper and cheaper and cheaper for people to want to use these ecosystems, for developers to build on there, for applications to launch, and for users to use it. Ultimately, I think users are never going to think about fees, and the applications themselves are going to cover the gas fee costs. But they're only going to do that if things get cheaper and cheaper and cheaper. And so I think the fee revenue we get right now, we get so excited about, and we're keeping an eye on so much because like Ethereum was making, I don't know, hundreds of millions of dollars a month previously, but that was all unsustainable. That was all dumb. No one was going to pay $60 per transaction for the future of finance. This is never going to happen. So people got so horned up over these ridiculous fees for absolutely no reason. It just made no sense, and it never was going to make sense. And then all of a sudden, Solana came along, and it was like, okay, this thing's super cheap, and it didn't have a lot of fees. And then all of a sudden, it started to get more fees as more users started using it. Now people are like, oh my God, it's catching up to Ethereum. It's getting more revenue. And then Ethereum launched the EIP 4844, and fees became very cheap on L2s. L2s weren't paying much back to Ethereum. They still aren't. And so people are all worried. They're like, oh my God, Ethereum has no more fees anymore, but Solana does. So like Ethereum's useless, and everyone's going to use Solana, and Sol's the best token, and blah, 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 blah. And I just think, guys, the whole purpose of these blockchains is to continuously get cheaper. And every single year moving forward, both Solana and ETH will only focus on getting cheaper and cheaper and cheaper for their customers. It's the whole point. And so every time that fees get up a little bit more, all the core devs are going to go, how can we get this thing cheaper? And so like, yeah, we had EIP 4844 that happened. Eventually, you're going to get a bunch more traction on L2s. I mean, every month it's already going through all-time highs. More and more people are going to go on there. It's going to start to get more fees. And then Ethereum's going to go, okay, what can I do now to make it even cheaper? And then even cheaper. And Solana's going to do the same freaking thing. And so I think fees are going to basically trend to zero. And so is MEV. This is the other type of revenue that blockchains can create. And I think both of those are going to trend to zero because it's better for the end user for it to trend to zero. And so I don't think we should ever be valuing any of these blockchains by fees. Now, I think that's the way we do it now. And the price action sort of reflects that. As ETH has gotten worse in fees, it's gone down. Solana kind of the opposite. And so I think that's the way we're currently valuing these assets. And I think we really need to stop. And we need to look at these assets for what they are, which is money within an ecosystem. So I'll leave it there. And there's probably a ton of questions because I know a lot of this is confusing. We'll talk more about all that, but I'll let you take the floor for a second.
It's never confusing when you explain it, Kai. So we're all gravy as long as the words are coming into your mouth. Okay, I want to touch on MEV and I want to explain what that is. But before we get there, and I also want to touch on moneyness and this term, because I think that is a key concept to understand. Is in order to understand the value of L1 blockchains, you need to understand the importance of their assets as money within their ecosystem. So you brought up two things that we're going to get to, but before we get to those, I just want to bring up a couple of charts to look at the fees on Ethereum and Solana. You mentioned this briefly, but if I pull up, here's the chart of Ethereum fees over the last, since 2018. So over the last 6 years since its inception. What do you see when you see this? Does this say the story that you're trying to tell us?
Yeah, I mean, so first of all, I mean, you have these crazy fees back last cycle when it cost so much to use Ethereum, which never made any sense. But people were so bullish on that. That was the best thing ever. And then obviously it goes down in bear markets, which happened in 2022. And then it started to climb back up over the last, year and a half or so as we started to get more bullish. Prices started to go up again, more activity. By the way, the fees that we're looking at here are gas fees. So basically, when people transact on top of Ethereum, there are, or not just people, when other chains transact and use Ethereum like layer twos, there's a fee that you have to pay, and that goes to validators. So that's the fees that we're looking at here. Now it's gone really, really low over the last little bit, part because price has been down for the last 6 months. So there's not a lot of activity, both on the layer one and on L2s, or L2s are not paying too much. And then also we had the EIP 4844, which brought down the costs for L2s to settle transactions or to put data on Ethereum. And so that became very, very, very cheap. And so now it's basically, you can think of it the broadband moment for Ethereum. It's got a bunch of supply now for block space, and it's not being used enough yet. There's not enough demand. And so its fees and revenues are very cheap as a result.
Right. A lot of people post this chart as a bearish chart. fees are going down. Therefore, Ethereum won't have enough revenue and won't be valued. But that's not how you feel. You're
No,
not
I think it's a
concerned.
super bullish chart because the thing is,
Right.
if you look at Ethereum and its entire ecosystem, its usage in terms of users and in terms of transactions and in terms of apps deployed is at all-time highs. And yet, it's the cheapest it's ever been for all of these apps and all of these users. What more could you ask for? That's perfect, right? The whole point here is to expand the ecosystem of crypto, get more and more developers, more and more users to use this. That's not going to happen if they have to pay $100 per transaction. No user is going to do that, and no app is going to launch on that. That's obvious, right? The only reason they did it 5 years ago is because there was nothing else but Ethereum. But now that there are cheaper blockchains and cheaper, L2s, of course, they're going to go and use the cheaper stuff because that's how you can scale and get social media on chain and get payments, et cetera, DPIN, all that stuff. Doesn't exist when it's really expensive. And so the fact that we are now getting super, super cheap for people to use Ethereum, the number one blockchain in the world currently, where all the liquidity is, all the developers are, that is extremely bullish, especially as we reach all-time highs on all the different metrics for users. That's exactly bullish. I don't know how you can take it any other way.
Right. So the natural follow-up question, which I don't necessarily want you to answer right now, but I know this is on the mind of all of our listeners, is okay, great that this is bullish, but if a business is not making revenue and their number one revenue source is fees, then can that business be successful long term? And your answer is yes, they can be successful even with low fees. Don't go ahead.
Don't answer it now. Well, I just want to say,
yeah.
don't think of this as a business, right?
Mm.
I think you need to think of it as an ecosystem, like a country. Yes, countries need revenue, but like they mainly just don't want to be in a ton of debt. They want to make sure there's a lot of growth happening, and then their asset gets used across the ecosystem, their currency, right?
Mm-hmm.
And it becomes the currency for their own company or their own country, and then maybe for other countries as well, right? Like gold has no revenues, but it's used as money, as a store of value, and so it works. Bitcoin is not, in terms of like a business, is not a sound business at all. It's bleeding every single month, and it has been since it first started. And yet it's still money, and it's worth 1 point whatever trillion dollars. And it's because it's used as money within not its ecosystem, because there's not much in its ecosystem, but like it's just used as money, store of value, a different means of money. But I don't think we need to think of these things as businesses as much as most people are.
Okay. And then just to quickly look at the Solana chart, because the Solana chart tells the story of no fees, no fees, no fees, no fees. And then starting at basically the start of this bull run, Q4 last year, all of a sudden fees started to skyrocket. And
and this is still bullish. Like Solana is very cheap to transact, and its fee revenue is coming up, is increasing, right? Now it's still not near Ethereum, but it's getting there. And so I still think this is bullish. And the reason I say this is the key here is that the average transaction fee, or just the median, whatever you want to call it, like the transaction fee for users needs to be extremely cheap. But if you get enough volume, then you'll get enough revenue from that while keeping the transactions really, really cheap. That's kind of the goal here. But the goal is not to just like print money and make as much revenue as possible. It's just get enough revenue so that validators are happy and that you're burning enough so that your inflation isn't too high, right? It's like in the US, inflation at 2% is fine. That's what everyone wants. There's still inflation, but 2% is still okay. You can have a little bit, right? As long as there's still new demand and more people coming to the country and more things happening in the country, it's all good to inflate just a little bit. And so even in Bitcoin's case, everyone's like, yeah, it's inflating at, I don't know, I think it's 0.8% or something right now. Like it's fine because there's enough demand that the price is still going up. And so I think revenues matter. What we want is for these assets to become deflationary, which you need revenues for that because we burn half the revenues essentially. That's how, more than half for ETH, and Solana, something similar. So like we definitely need to control inflation. The problem right now, Solana has like 6-7% inflation, right? Ethereum has like 5 or 0.6. And so a little bit boost in revenue, which we'll get as activity comes up, will make ETH deflationary, right? Or close to it, or neutral. That is fine. That's all you need. It doesn't need to be any more than that, right? Now, it's a bonus if it gets more. And I think in 10 years from now, when volumes and transactions and users 10x, 100x, 1000x, 10,000x, you got to understand like what's happening right now does not really matter in crypto. We're going to have so many more transactions as everything moves on chain that as long as we can continue to make things cheaper and cheaper and cheaper so that we can have a 10,000x increase in volumes and in transactions, then you're going to have enough revenue to keep these assets deflationary, right? And so I think people are kind of missing that aspect. Is like the revenues don't really matter right now. It's so small. Who gives a shit? Let's just keep trying to get cheaper so we can get more apps, more innovative apps that can't exist on blockchains today.
Okay, so fee revenue does not matter to the success of a blockchain, of an L1 blockchain long term? Right now, fee revenues are very high, so it's very easy to look at that and say, hey, that's amazing, great business, let's invest. Let's talk about MEV for a second. What is MEV and how does MEV impact L1 blockchains?
Yeah, so MEV, this is the sort of second way that blockchains can accrue revenue. And when I say blockchains, I mean validators can actually accrue the revenue. And Kyle Samani from Multichain Capital is the one that comes out saying, look, fee revenue doesn't really matter. That's probably going to zero. MEV is actually all that matters. And if you don't know what MEV is, all of you have had the negative impact of MEV, which is basically this. When I try to initiate a transaction on a blockchain, it's public. So when I say, hey, I want to swap, my $100 of USDC for $100 of ETH, that's public. And so there's about 15 seconds or whatever between blocks on Ethereum, for example, and however long it is on other chains, doesn't really matter. But what that means is there's a little bit of time for validators or for bots, whoever, to arbitrage that and to actually put in a transaction before me that undercuts that and makes the price go a little bit lower so that they can actually get the better price on that trade and then they can skim the top off me. And so I'm actually never getting the best price. This happens everywhere in blockchains. It happens even in the traditional world. Every time you go to buy an asset in the traditional world, there is MEV type that is sort of taking a cut from you. It's like a hidden tax, basically. Now, the good thing about blockchains is we can actually prevent this. Now, we don't know exactly how to do it yet, but we've got apps and we're kind of working on ways to start preventing this. And so Kyle Samani, anyway, thinks that MEV is going to be the biggest thing and that's really what matters. And Solana is doing a really good job at basically getting MEV, which means stealing money from users, right? Which is a bit ridiculous, but that's what he thinks. Ethereum had that as well, but then layer 2s kind of take away from that because Ethereum doesn't get any MEV anymore. L2s take all that MEV, so the Ethereum validators don't. So people think that's a big problem. Again, I don't think this is an issue. I think MEV is going to zero. And the reason I say this, I think we already have innovative ways to get rid of it. If you think of the incentives of where are things going to go, if an app can launch and not have MEV so that their users don't get scammed, what do you think is going to happen? Of course, they're going to go the route of not getting scammed. If users can choose to use an app that doesn't scam them and they can get a better rate, what do you think they're going to do? They're going to go the route of not getting scammed. Okay. Now in the traditional world, we don't have that choice. I have to get scammed every single time because it's not an open public ledger. I can't just go and do something else. My money's in Robinhood. I'm getting scammed by Robinhood. There's nothing I can do about that. Right. But in crypto, on blockchain, it's very different. And so I think that MEV will go the way of nothing down the road. And so I think MEV doesn't matter. Fees matter a little bit, but just enough to make it, deflationary-ish. But I don't think, again, it's the way that we need to value an asset.
Okay, so the obvious follow-up question is, if everybody in the world thinks that fee revenue matters and that MEV matters, and you're saying it doesn't, what does matter when we're valuing these blockchains?
So I think it's money. And when I say money, I don't mean using these assets to pay for coffee. We'll probably never use ETH or Sol or Bitcoin or whatever to pay for coffee. Like that's just people are delusional. We'll probably just continue to use USD or USDC, USDT, blah, 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 whatever. Where I think we'll use these assets as money is multiple different ways. One, in DeFi as collateral. If I want to get DAI, right, or I want to get SUSD, which is from Athena, if I want to get out a stablecoin, I use my ETH to as collateral to get stablecoins, right? If I want to take out a loan, if I want to lend, I'm usually going to do that on ETH, and even better, ETH that's staked because it gets a bit of yield. Same with Sol. Sol that's staked, that gets yield. These are the best assets I could possibly use for money, for collateral. Trading pairs on dexes. Every time you put an asset on a dex, like when I use Uniswap, if you want to get USDC, there has to be a trading pair on there. Usually it's done with the native asset of the blockchain. Sometimes it's also done with stablecoins, but the native asset is also often there. Gas fees. Every app, every user, whatever that wants to use Solana or wants to use ETH or anything in the Ethereum ecosystem, they have to use that native token as a gas fee. And so there is a money there for the digital ecosystem. And I think that the more that these ecosystems or these blockchains kind of proliferate, they get more users, they get more applications, they get more use cases, they get more developers. It just means that these assets are more proliferated as money throughout their ecosystems. Now, why use ETH on Ethereum or Ethereum L2s instead of Maker token or Aave token or whatever? The key answer here, and the one thing that we know will always be true, is that ETH will always be the most trustless asset on Ethereum. Sol the same for Solana. Why? Because I don't need a team to launch the token of ETH. It just exists natively on the blockchain. Every other asset, I don't care what it is, a stablecoin, a token for a company, a real world asset of a stock, I have to have a team that launches that and controls that. And then I also have a smart contract that has to initiate that. And so there's risk of the team and there's risk of the smart contract, always. but there is not that for ETH and there's not that for Sol. And so for the native tokens of L1s, they are money. They are collateral because they are the most trustless asset. They are already a form of money on the ecosystem by default, and there's nothing anyone can do about that because you cannot transact on Solana without paying in Sol, and same with Ethereum without paying with ETH. Even all the L2s, everyone says L2s are parasitic because Optimism can use OP as its gas token. Don't care. I can still pay OP to transact on OP, but it still has to pay ETH to settle those transactions up on Ethereum. And so it's always going to be gas money on these ecosystems. It's always going to be the most trustless. And so it would make sense that it becomes the collateral. It's also the most decentralized token, meaning it has the most holders of any other assets on there. It's hard for anyone to compete with that because you need to hold it to pay for gas. So there's so many reasons that make these assets money on their ecosystem. Now, all that matters, of course, money on an ecosystem doesn't matter if there's nothing on that ecosystem, right? So like it needs to be a vibrant ecosystem. And so as long as there are things being built on it that need to use that asset, then it becomes more and more money. And that is the demand for these tokens, right? If you look at ETH right now, it's something like 40 or 50 or whatever it is percent is in smart contracts. 30% of that or 30 something percent of that is in staking. And another 10, 15% is in DeFi. That is money. That is collateral. That is so much demand. And that just continues to happen, right? And so the more L2s that do well on Ethereum, it's not parasitic to Ethereum, not at all, because all it does is proliferate ETH as money, right? Doesn't matter if that L2 is ETH aligned or not ETH aligned. I don't care. Doesn't matter if it uses ETH as gas or not. Again, doesn't matter, because when they have DeFi protocols on there, people are going to use ETH because it's just the most trustless asset that exists. And again, Optimism or whatever L2 that succeeds, they still have to use ETH as collateral. And actually, if you want to bring up the screen share here, Token Terminal just put out a really cool new metric, which I thought was quite interesting. This came out like the other day. And if you look at this metric, it's looking at Base, okay? And it's saying of all the protocols that are on Base, let's look through every single protocol. What is the asset that is used the most on every single protocol that exists on Base? ETH wins every single time. Every single time, it's the most used asset. So that is a clear indicator that ETH is being proliferated as money across L2s. And yet this is the thing that Kyle Samani and all these other people hating on ETH right now are building this narrative that ETH is not money and L2s are parasitic to ETH. But in fact, if you just look at the metrics, they are not at all. Every L2 just pushes ETH further along as being money. And again, when I say money, it's not about buying coffee. I don't think we will ever use ETH to buy coffee. It's to use in digital ecosystems. So this is a weird concept for people. It's hard for people to wrap their heads around. It's also one that you can't like measure. Like I can't just look at a chart of like how money is ETH, you know, whereas I can go how much revenue or fees did Ethereum generate. So it's easier for people. And so I think that's why there's confusion. And there'll probably continue to be confusion for a while. But I think these assets will do well, both Sol and ETH, even if the revenues don't matter, just for the fact that they become money and there's just demand for that.
So the utility of these tokens within their ecosystem is the key to their long-term success, is what you're saying.
So. I think so. I just don't see how it could be any other way. One, again, because it's the most trusted. If you're going to ever put a loan out on Ethereum for, I think institutions here, for hundreds of millions of dollars, there's no other token that competes with that right now. Nothing, right? Like you're not going to use any other token except for maybe a stable coin. But a lot of times you want to use collateral of something that could still appreciate. No other token's remotely close to being trustless enough and never will be. But also no token is remotely close to being as like, let's call it decentralized in terms of its holders, right? Not having the risk. Every other token is so small. They're like the biggest tokens on Ethereum that are not stablecoins are like, I don't know, like what's Uniswap, like 8 billion FDV. But it also has unlocks. Like no one's using that as in hundreds of millions of dollars as collateral. They have to use ETH. Now, maybe eventually in 5 years from now, Maker token becomes so valuable and so good, and there's no more token unlocks and whatever that people start to use as collateral. But that's 5 years from now, maybe, right? Or maybe it's 10 years from now. Do you know how much network effects ETH has over the next 5 years to build up as collateral? Like so much. And this isn't even counting like what happens when restaking comes in. If ETH continues to be the dominant token for that, or Sol over on the Solana ecosystem, again, I just don't see how anything can take over its moneyness. Now, the only one that I've heard that could come true, I was talking to actually someone we had in the episode last week, and what he was saying is that the only one that could compete with this is Bitcoin. Bitcoin is currently the best form of collateral. The problem with Bitcoin is it doesn't have a vibrant ecosystem. There's nothing to do with your Bitcoin on the Bitcoin blockchain. And when Ethereum first launched, we had wrapped Bitcoin, which still exists, but to a lesser extent, but it was very popular. where you would put your Bitcoin in Maker or in Aave or whatever. And so there's still the chance that that happens if Bitcoin continues to proliferate. The problem is that, again, there is centralization risk because someone needs to custody that Bitcoin, right? Right now, like for wrap Bitcoin, the biggest one we have, it's like BitGo or whatever. So we have to trust an exchange, which is a bit odd, right? Especially with the Bitcoin ethos and the Ethereum ethos. And then there's also just smart contract risk too, right? Like I have to bridge it over. There's a bridge risk. Then I have to have it as this ERC20 token that's wrapped. Like there's a lot more risk there than even just the ERC20s that exist on Ethereum. And so maybe Bitcoin becomes the collateral on Solana and on Ethereum and on Ethereum L2s. And then, okay, that could be an issue for ETH and Sol. I just don't see that playing out because there's so much risk there. So it doesn't really make sense to me either, but maybe we'll see.
Before we wrap here, Kai, what would you say are the most common misconceptions that we discussed in this episode that like all of our listeners could take away and be like, hey, erase these from your mind and try to, because these are very difficult things to wrap your head around because blockchains are totally new tech. It's like trying to wrap your head around the internet at the start of the internet.
Yeah. I think the biggest thing is don't look at where we are now and think that this is how it's going to be 5-10 years from now. Think about, okay, for this all to work, I think everyone here listening to this episode right now believes that we are going to get it to the point where on-chain is just like online, right? It's like everything we do is now on-chain. Think about what that world looks like if that happens. It means billions of users, right? It means quadrillions of transactions in volume, like numbers you can't even imagine. If the whole financial system comes on-chain, and social media comes on chain and everything we do basically becomes on chain, which I think we all think is going to happen. Think about how much scale we need, right? Everyone thinks right now, like Solana is the NASDAQ of whatever. It's trying to be the fastest blockchain. If you don't think that Solana is going to have L2s, it already has 5, by the way. But if you don't think Solana is going to have L2s, it is. They already have launched network extensions, which is an L2, because they are going to have scale issues as well. I don't care what anyone says. If any chain is going to be successful, it has to process billions of people and billions of transactions, which is nothing like what we're doing today, not even close. And so we have to keep getting these blockchains cheaper and cheaper and cheaper. And so Ethereum and L2s, that's all they're going to do over the next 10 years, and Solana as well. And so the fees and the revenues and the users and all this stuff we look at now is all useless. It does not matter. So think about where will we be in 10 years when all these chains just consistently get cheaper and cheaper and cheaper and cheaper. And that's their only goals for the next 10 years because everything is moving on chain. In that world, what matters? Maybe fee revenue matters. Probably MEV doesn't exist, I would think. It might not. I could be wrong there, but I'm pretty sure it's going to go away. And fee revenue actually at that point probably will be pretty large if we have billions and billions and trillions of transactions. Like at that point, maybe it matters a little bit. And that keeps these assets deflationary, which is great. But ultimately, I think we got to understand, where are these assets going to play a role? How are they going to make sense in these ecosystems? And think of them as ecosystems, not necessarily as businesses, right? Ethereum's whole goal is not to get you and I to go and transact and use it. Absolutely not. Their whole goal is to get businesses and other blockchains to come and use its network, right? Solana, same thing. Its whole goal is to get applications, and really it's probably to get Web2 companies like Twitter, et cetera, to come and like link in and integrate into their chains. That's the world we're moving to. And so all these chains just need to get cheaper and cheaper and cheaper. And we're not going to use blockchains like we do today. And so I think it's these underlying assets that are going to matter for collateral and as gas, et cetera, like as money. I think that's what's going to matter for these L1 assets specifically. This is not true. And I want to make this really clear here. This is not true for every other token in all of crypto, including L2 tokens. These are all businesses and they need revenues. They are not money and they probably never will be money, right? But L1 native tokens are just very different than anything else out there. And I think that's something we all need to wrap our heads around.
Kyle, thank you so much for setting the record straight and helping us understand how to value L1 blockchains, because it's a very difficult thing to do.
Well, what's funny is this doesn't even answer the question on how to value it. I don't know how to value what is money. And I don't know that anyone does, right? So like, I just think it's like, as long as I keep seeing it being used as money and again, by its collateral, et cetera, then that's a good thing. And that means demand. How much demand? What does that mean for the price? Like, not a goddamn clue. And I don't think anyone will figure that out for, I don't know. I'm sure someone will figure it out, but like, I'm not smart enough to figure that out. Not right now.
But basic supply demand concepts would tell you, so long as demand increases, which it is consistently over the past like since the existence of these smart contract blockchains, and adoption continues to increase, which it also is increasing. And then there is some form of deflationary supply is decreasing, which, as you said, Solana hasn't figured it out. But
I think the key is we're going to keep seeing these moments where all of a sudden the fee revenue goes down so much because we found an unlock in the tech to make it faster. Like we just saw with Ethereum. Like everyone's so worried, but it's like, yo, this was a huge unlock. It's so cheap now. Right now, eventually it's going to get more expensive as more apps come on, and we're going to have to do it again. And so we're going to see a big drop in revenue once again. We're going to keep almost like reinventing the company and like cutting out at its knees and getting rid of all of its revenue. And like, okay, let's figure it out again. Now that we're so cheap, what else can we build that's new that wasn't possible before? And then we'll do it again. And we'll keep doing that. I think Solana will do the same.
But that's a good thing. That's a good
100%.
thing, because as it gets cheaper, more scale, more people can use it, more businesses can come on board. The movement from the migration to on-chain can happen at a faster rate. And that's what we want. That achieves more adoption.
And then these assets, because they're the most trustless, automatically just by default become the money that all these things use, just by default, because they're the gas token and they're the most trustless. So I think don't worry about fees and revenue. It's a nice signal, but it doesn't actually matter. When you see a huge cut, this is a bullish signal, in my opinion. Now, I could be wrong, and maybe people don't care, and that's just the way it goes. But like, I'm pretty sure this is how it's going to play out. And we have these debates internally with the Milk Road Pro research team all the time, and it always comes back to the same thing. So we'll see what happens.
Kyle, thanks so much for joining us today and taking us through this great episode. Everybody, thanks for listening in. Have a wicked awesome day. As always, if you liked today's episode, please hit subscribe and make sure you follow us so you don't miss out on the next one. There's also a link in the description to our free 5-minute daily newsletter where we simplify crypto for you while making you laugh. And if you're willing to step up your crypto investing game, we're going to also leave a link for Milk Road Pro. You get access to our portfolio where you can see exactly what we are buying. This is your #1 resource to help you invest successfully in crypto. One final note, this show is for educational purposes only, and nothing we say is financial advice. Investing in crypto or any asset is risky, and you should never invest more than you can afford to lose. Thanks so much for listening in, my friends. Have a wicked awesome day.